In Bitcoin's early years, virtually no major institutions held Bitcoin. It was a retail-driven peer-to-peer phenomenon. And fast forward to 2025, and the landscape has changed dramatically. Institutional players, including public companies, exchange-traded funds, ETFs, and even governments now control a sizable share of Bitcoin's supply. Over the last few years, institutional ownership has surged to roughly 8% of Bitcoin's total 21 million supply. And when you add sovereign holdings, it tops 10% of all Bitcoin. In absolute terms, that's over 2.2 million Bitcoin sitting in corporate treasuries, ETF custodians, or government reserves as of 2025. This is a stunning leap from near zero a decade ago. Major companies like MicroStrategy and others alone hold 700,000 plus Bitcoin, over 3.3% of all Bitcoin that will ever exist, signaling that institutions are making long-term bets on crypto. Add to that nearly 965,000 Bitcoin in spot ETFs, roughly 5% of total supply, it's clear that Wall Street and even nation states, which are the new whales, have piled into Bitcoin in a big way. In 2017, skeptics scoffed at the idea of institutions buying Bitcoin. For instance, BlackRock CEO Larry Fink infamously called Bitcoin an index of money laundering. Yet a few years later, BlackRock and peers raced to launch Bitcoin funds and ETFs. The result? Bitcoin's once highly distributed supply is consolidating. One analysis in mid-2025 found that 216 centralized entities, which are exchanges, funds, companies, and governments, now hold over 30% of the circulating Bitcoin. In other words, whales aren't just anonymous early adopters anymore. They're institutions with deep pockets. This stealthy accumulation by big players sets the stage for what may be the biggest cover-up in crypto. The notion that Bitcoin is still a purely decentralized retail market when behind the scenes is being scooped up and locked away by powerful organizations. Bitcoin's exchange balance, which is how much crypto is actually on exchanges, has plunged to 11% by 2025, the lowest price ever since 2018, as institutions and long-term holders pull coins off exchanges into long-term storage. The black line shows Bitcoin's price, which rose as exchange supply dropped. One of the clearest signs of this quiet takeover is what's happening on-chain. Bitcoin held on exchanges has plummeted to multi-year lows, indicating that coins are being withdrawn secretly to cold storage in mass. In fact, only about 10 to 11% of the Bitcoin supply now sits on exchanges. Bitcoin's exchange balances peaked around 17% of supply in March 2020, and then began declining as institutions and savvy holders started yanking 1.26 million Bitcoin off exchanges over the next few years until today. This means far fewer coins are liquid and available to trade, a recipe for potential supply shock. Why the exodus from exchanges? Institutional custody is one big reason. Instead of leaving coins on Binance or Coinbase retail exchanges, large players are using custodians and ETF structures. For example, Coinbase's institutional custody arm, Coinbase Prime, saw massive inflows from ETF issuers and corporations, growing to $2.12 billion in assets under custody. Even with the standard Coinbase exchange, bled over 500 million of Bitcoin outflows in one quarter. In aggregate, spot Bitcoin ETFs worldwide have vacuumed up coins. Their assets under management rocketed from just $1 billion in early 2024 to $44.5 billion by mid-2025 today. Investors are clearly preferring to hodl. On-chain metrics show Bitcoin hodlers activity at a 2-year high, and long-term holders display strong conviction by not moving their coins. This trend accelerated after the 2022 FTX collapse, which shattered trust in centralized platforms. From late 22 through 2023, we saw one of the largest withdrawal periods in Bitcoin history, with week after week, tens of thousands of Bitcoin flowed off exchanges. Where did all of that Bitcoin go? Likely into institutional coffers and personal cold wallets beyond the reach of immediate trading. In essence, Bitcoin's float is shrinking and is only going to continue. A huge portion locked up by ETFs, corporations, governments, and whales who aren't selling. This creates a cover-up of sorts. On-chain data like balances might suggest a looming supply crunch, yet prices remain range-bound or drop in the short term. Why? Because demand is also increasingly concentrated in fewer hands, who can algorithmically manage how that supply hits the market. More on that next. For the average investor, these dynamics are largely invisible until a sudden squeeze or rally reveals just how scarce liquid Bitcoin has become. If and when demand spikes again, the firepower of big players could quickly translate that scarcity into violent price moves, potentially to the upside. It's a question of when, not if, given that 83% of institutional investors plan to increase crypto exposure, given a 2025 survey from Cointelegraph. The stage is set: a dwindling supply on exchanges, a rising tide of institutional holders, and a market structure radically changed from the Wild West structure of Mt. Gox years ago. It's not just who holds the Bitcoin that's changed as well. How the market trades has also undergone a quiet revolution. These days, the harsh truth is that people aren't pushing most of the buttons in crypto markets. Trading bots and algorithmic programs dominate trading volumes, both on Wall Street and crypto exchanges. Consider this. It's estimated that more than 80% of daily trading volume in US markets is executed by computer algorithms rather than human traders. In crypto, a similar, if not greater, algorithmic takeover is underway. By 2024, roughly 70 to 80% of all crypto trade volume was being driven by automated trading systems, bots, executing orders in milliseconds based off code, not emotion. In other words, if you're a retail trader clicking buy and sell on an exchange, you're playing in a sandbox largely controlled by high-speed, automated actors. Institutions and quant funds rely heavily on these automated algorithmic strategies. High-frequency trading firms, crypto hedge funds, and even market-making bots are all competing in a digital arms race that retail traders are losing. These sophisticated algorithms to arbitrage price differences, front-run large orders, and scrape profits in ways that a human simply can't. For example, some specialized trading bots watch for typical retail trading patterns and then exploit them, anticipating moves and jumping in between to take a cut. This might manifest as pumping up spikes or stop-loss hunting wicks that famously and frequently liquidate over-leveraged retail positions. Price moves that often seem engineered. Not all algorithmic trading is nefarious, of course. Many bots simply provide liquidity or execute large orders over time to minimize market impact. But the playing field is anything but level. Algorithms remove human emotion and bias and react in milliseconds, giving institutional players a huge edge. They can digest news or on-chain data and trade 24/7 without tiring. Studies show 60 to 75% of trading volume in major traditional markets is algo-driven, and crypto is likely on par or potentially far higher. This means the crypto market's behavior, the volatility, sudden crashes, and spikes is often a product of algorithms interacting, sometimes creating feedback loops. One bot might dump a large position, triggering stop losses that other bots detect and amplify, and so on. Fake volume and wash trading add another layer. A 2019 analysis by Bitwise suggested that up to 95% of reported Bitcoin trading volume on unregulated exchanges was fake, generated by bots to attract attention. So not only are bots trading most real volume, they're capable of simulating activity to mislead traders. All of this contributes to the cover-up narrative. On the surface, prices move and volume prints as if a million independent traders are active. But behind that, a small handful of algorithms run by institutions might be pulling the strings. The average person sees a market price and assumes it reflects crowd sentiment. In reality, it might reflect the strategic plays of a few big algos interacting. This isn't science fiction. Even regulators acknowledge that algo trading can manipulate market liquidity and perception. Crypto, being less regulated, is an even easier playground for such tactics. Front-running bots have been observed on decentralized exchanges, sniping trades within a single block to profit from other users' orders. On centralized venues, latency arbitrage bots literally profit from being microseconds faster. It's an arms race most retail investors don't even know is happening. The bottom line is that the crypto market today is heavily automated and institutionally driven. When you hear that the house always wins, think of these institutional bots as the house-rigged machinery. They're not foolproof, but going up against them without any plan is like bringing a knife to a gunfight. To survive and thrive, you need to stay out of their crosshairs or use similar tools at your disposal. More on that solution later. All these threads lead to a striking conclusion. The crypto market isn't what it used to be, and insiders may prefer you to not know that. This is the single biggest cover-up in crypto history. It's essentially the gradual centralization and manipulating of a market touted as decentralized and fair. Think about it. Bitcoin was born from a philosophy of empowering the little guy, cutting out big banks and middlemen. Yet today, Wall Street giants and even governments quietly hold huge Bitcoin stashes, and they trade them in ways that skew the market to their advantage. It's not just a conspiracy theory, it's born out of the data that I've presented, running the majority of trading volumes via bots. What's covered up here is not just a single event, but a reality that's happening every day, every millisecond. The crypto playing field has tilted in favor of those with the most capital and the best algorithms. Now, consider how public narratives often diverge from private actions. We saw major figures publicly dismiss Bitcoin as worthless or dangerous while their firms were buying up in the background. Jamie Dimon of JP Morgan called Bitcoin a fraud in 2017 and threatened to fire any trader buying it, even as JP Morgan's traders in London were reportedly buying Bitcoin. This pattern of talk down the price while quietly accumulate has led many in the community to suspect that market dips and fear, uncertainty, and doubt are sometimes orchestrated. When retail investors panic sell on negative headlines, guess who's often buying up those cheap coins? Data shows that whales and institutions frequently increase their holdings during major sell-offs, while smaller investors capitulate. For example, in early 2025, as Bitcoin's price pulled back from a surge, whales scooped up over 200,000 Bitcoin while retail investors sold off. This isn't merely coincidental. It reflects an information and strategy asymmetry. Big players plan in quarters and years with teams of analysts and bots, whereas retail traders often react in days or hours to market noise. These dynamics aren't obvious to a casual observer. You won't see a press release about Wall Street algorithm manipulates crypto prices, and on the surface, Bitcoin's network is decentralized as ever. No single entity controls the protocol, but ownership and market influence are far more concentrated than the idealistic crypto ethos would suggest. Even the on-chain transaction volume has skewed towards institutional channels. Over 75% of Bitcoin's transfer volume is now funneled through centralized exchanges, ETFs, and regulated platforms, rather than pure peer-to-peer transfers. Additionally, Bitcoin's correlation with stocks has tightened, meaning it's trading more like a mainstream risk asset, influenced by central bank policy and equity sentiment, a consequence of institutional involvement. Annualized volatility has been trending down since 2018, which on one hand signals a maturing market, but on the other hand suggests the days of an entirely freewheeling, retail-driven market have faded. To be clear, Bitcoin is still far from being controlled by any one entity. About 85% of supply remains outside formal institutional hands, and the network itself is decentralized. However, the influence of large holders and algorithmic trading is casting a long shadow. Retail traders find it harder to discern true market signals from algorithmic noise, and on-chain metrics that used to gauge retail sentiment now have to be interpreted from the context of institutional hoards. For example, if millions of Bitcoin are in ETF cold storage, on-chain activity drops without necessarily indicating low interest. It might mean that those coins just aren't moving. The biggest cover-up is the gap between the narrative and the reality. The lie is that Bitcoin still empowers the little guy against the financial elite. The emerging reality is that financial elite have found ways to co-opt Bitcoin's market dynamics while publicly denying or downplaying it until they've secured their positions. And for you, this realization should be eye-opening and a bit alarming. It means that simply buying and hodling or day trading by gut feeling now pits you against some of the most sophisticated players on the planet. But it's not a lost cause. In fact, knowing this truth is empowering, because once you understand how and why the market moves, you can adjust your strategy accordingly. Which is why in the next section, I'll discuss exactly what a regular crypto trader can do in a market dominated by whales and bots. The good news is, the same technology used by institutions can be leveraged by individuals too, if you know how. Going head-to-head with institutional bots is a quick way to get wiped out. These algorithms are psychologically engineered to exploit human biases, front-running stop losses, hunting liquidity, and reacting in microseconds to news or on-chain signals long before you can click buy or sell yourself. It would be madness to trade against them with nothing but gut instinct. The true solution is to use a statistically validated bot yourself, one that counters their bot and has been stress tested across thousands of randomized market scenarios, not just a single historical backtest. That's why I built my own. My Python backend runs Monte Carlo simulations on every new parameter set, verifying performance across a wide variety of possible futures, because my bot's rules weren't just tuned to last year's bull market, but to dozens of alternative histories, dozens of bull and bear market. The live results you see on my channel are far more likely to hold up in real time. That's why I'm betting real capital on it, and why you should go to wop.com/trade-tactics to subscribe to it yourself if you want to participate. If you made it this far, follow the channel and like the video for ongoing performance updates and to see how a rigorously trained strategy can finally level the playing field against those institutional machines. I'll see you in the next one.